You know that sick feeling when you open your brokerage app and everything's red? March 2020, your portfolio dropped 34% in 3 weeks. October 2008, you watched your retirement account get cut in half. And if you're like most people, your first thought was, should I sell? Your second thought was, when will this recover? Here's the thing. Market crashes are terrifying, but they follow a pattern. Panic, capitulation, recovery. The S&P 500 has crashed 9 times since 1950, and every single time it came back. Sometimes it took 6 months, sometimes 3 years, but it always came back. That's why your financial advisor tells you to stay calm and keep investing. But what I'm about to show you isn't a crash. It's something fundamentally different. It's a repricing. And the difference between those two words will determine whether your retirement works or doesn't. I've been managing my own money for over a decade. I've got multiple hundreds of thousands of dollars spread across index funds, real estate, and alternative assets. And for the last 4 months, I've been reading Federal Reserve meeting minutes, commercial bank earnings calls, and Treasury auction data that most people never look at. What I found keeps me up at night, not because of what might happen next quarter, but because of what's already happening right now that nobody's talking about. Most people think market crashes and repricing events are the same thing. They're not. And understanding the difference is the most important financial concept you'll learn this year. A market crash is a temporary dislocation. Something breaks, people panic, prices collapse. Then smart money comes in and buys the dip. Within 18 to 36 months, we're back to where we started. This happened in 1987, 2000, 2008, and 2020. The pattern is consistent. Fear, capitulation, recovery. But here's what most people miss. A crash happens within a stable system. The rules stay the same. A dollar is still a dollar. Bonds still pay interest. Real estate still generates rent. The fear is temporary because the fundamentals haven't changed. A repricing is different. A repricing happens when the underlying assumptions of the entire system change. It's not that stocks went down 30%, it's that the formula we use to value stocks no longer works. The measuring stick itself changed. Here's the truth most financial advisors won't tell you because they don't understand it themselves. We're not heading into a crash. We're heading into a repricing event. And the difference is this. After a crash, your portfolio recovers to the same purchasing power. After a repricing, your portfolio might show the same number on the screen, but that number doesn't buy what it used to buy. Let me show you what I mean. In 2008, the S&P 500 dropped from 1565 to 676. That's a 57% crash. Brutal. But by 2013, we were back to 1565. If you held through the crash, you recovered completely. The system didn't change. The rules stayed the same. Now imagine this instead. The S&P stays at 6,800, but inflation runs at 6% for the next decade instead of 2%. Your account balance doesn't crash, it just sits there looking fine. But in 10 years, that $500,000 only buys what $280,000 buys today. You didn't lose money on paper, you lost purchasing power, and there's no recovery from that because the system itself repriced. That's what's coming. And most people aren't ready because they're still preparing for the wrong disaster. But here's where it gets really interesting. The signs of a repricing event are completely different from the signs of a crash. In a crash, you see panic. VIX spikes to 80, trading halts, circuit breakers, headlines scream, worst day since Black Monday. In a repricing, you see something much quieter. You see the 10-year Treasury yield sitting at 4.5% while inflation is running at 3.8%. You see commercial real estate lenders extending loans they should be foreclosing on. You see regional banks with unrealized losses of $600 billion on their balance sheets that accounting rules left them pretend don't exist. You see the Federal Reserve reducing its balance sheet while the government is running a $2 trillion deficit. None of this makes headlines, but all of it points to the same thing. The financial system is repricing the value of the dollar, the value of debt, and the value of every asset denominated in dollars. And when that repricing completes, your 60-40 portfolio is going to look very different than your financial plan assumed.
Let me break down why a repricing event is structurally worse than a crash through 5 things that are happening right now that most people aren't paying attention to. First, The debt spiral has gone exponential. The U.S. national debt just crossed $36 trillion. But here's the part that matters. The interest payment on that debt is now over $1 trillion a year. That's more than we spend on defense, more than we spend on Medicare. We're now borrowing money just to pay the interest on money we already borrowed. Most people hear that and think, okay, that's bad, but we've had debt before. True, but here's what changed. In 2008, when the debt was $10 trillion, the average interest rate on that debt was 2.4%. Now the debt is $36 trillion, and the average interest rate is climbing toward 4%. That's not a linear increase, that's exponential. Here's the math. If you owe $10,000 at 2% interest, you pay $200 a year. Annoying, but manageable. If you owe $36,000 at 4% interest, you pay $1,440 a year. That's a 7x increase in debt service for a 3.6x increase in principal. This is what compound interest looks like on the wrong side of the equation. And here's the kicker. To keep paying that interest, the government has to issue more bonds. To get people to buy those bonds, they have to offer higher yields. Higher yields mean higher interest expense next year, which means more borrowing, which means higher yields. It's a feedback loop, and feedback loops don't stop until something breaks. In a crash, this would show up as a sovereign debt crisis. Bond yields would spike to 10%, the stock market would collapse, and we'd have a definitive crisis moment. But in a repricing, it shows up differently. Bond yields grind slowly higher. 4.2%, then 4.5%, then 4.8%. Not enough to trigger panic, but enough to systematically destroy the assumptions your retirement calculator is built on. But here's where most people mess up their understanding of what this means. Second, the Fed is trapped between two disasters. In every previous recession, the Federal Reserve had one job: cut interest rates, stimulate the economy, and get things moving again. In 2008, rates went to zero. In 2020, rates went to zero. The playbook worked because inflation was dead. Now, look at where we are. Inflation is still running above 3%. The Fed funds rate is at 4.5%. If a recession hits and the Fed cuts rates to zero, inflation explodes. If the Fed keeps rates high to fight inflation, the recession gets worse, and the government's interest expense becomes unsustainable. This is what economists call a policy trilemma. You can't have low inflation, low unemployment, and low interest rates all at the same time when you're running a $2 trillion deficit. Something has to give. In a crash, the Fed picks a side. They either cut rates and accept inflation, or they hold rates and accept a recession. Markets panic, then adjust. But in a repricing, the Fed tries to thread the needle. They do small cuts, hoping to avoid both disasters. And in the process, they create a third disaster. Asset values stay elevated on nominal terms, but purchasing power erodes faster than returns compound. Here's what that looks like in practice. Let's say you have $400,000 in your 401k. Historical models say that should grow to $1.2 million by the time you retire in 20 years, assuming 7% returns. But if inflation runs at 4% instead of 2%, that $1.2 million only has the purchasing power of $550,000 in today's dollars. Your account balance tripled, but your lifestyle got cut in half. That's a repricing. And there's no circuit breaker to stop it, because technically nothing crashed. Now here's the part that will blow your mind. Third, commercial real estate is a $20 trillion time bomb that's diffusing in slow motion. Office buildings in major cities are sitting at 50% occupancy. Nobody wants to go back to the office full time. That means half the demand for commercial office space evaporated permanently. If you own a building that was worth $100 million in 2019 based on rental income, and rental income just dropped 40%, your building is now worth $60 million. In a normal crash, this would show up immediately. Building owners would default, banks would foreclose, prices would collapse, and we'd see headlines about a commercial real estate crisis. But that's not happening. Why? Because of a quirk in bank accounting rules called held to maturity. Banks don't have to mark their commercial real estate loans to market value as long as they're performing, meaning the borrower is still making payments. So banks are extending loans, restructuring terms, doing anything to avoid recognizing the loss. The FDIC estimates unrealized losses on commercial real estate loans across regional banks are somewhere between $500 and $700 billion. That's larger than the entire 2008 subprime mortgage crisis. But it's not showing up in earnings reports because accounting rules let them pretend the buildings are still worth what they were in 2019. This is a repricing in real time. The buildings are worth less. Everyone knows they're worth less. But the financial system is pretending they're not, because recognizing the truth would trigger a cascade of bank failures. So instead, we get this weird slow-motion collapse where values erode over years instead of crashing in months. And here's what that means for you. If you own bank stocks, REITs, or bond funds with exposure to commercial real estate debt, your holdings are being repriced down slowly, not a crash, a grind. And by the time it shows up in your account balance, the damage is already done. And here's what changes everything. Fourth, the dollar's reserve currency status is eroding faster than official metrics show. When I say the dollar is the reserve currency, here's what that means in practice. If Japan wants to buy oil from Saudi Arabia, they do the transaction in dollars. If Brazil wants to trade with India, they settle in dollars. This creates structural demand for dollars that has nothing to do with the U.S. economy. That demand is what lets the U.S. run massive deficits without consequences. We can print dollars and the world absorbs them because they need dollars for trade. It's the ultimate economic cheat code. But here's what's changing. In 2022, Russia invaded Ukraine and got locked out of the SWIFT payment system. That was supposed to cripple them. Instead, Russia started settling oil trades with China in yuan. India started buying Russian oil in rupees. Brazil and China signed a currency swap agreement to bypass the dollar entirely. The data on this is striking. In 2001, 73% of global foreign exchange reserves were held in dollars. By 2024, that number dropped to 58%. That might not sound dramatic, but think about the direction. We're losing 1% a year, and the pace is accelerating. Here's why that matters. Every 1% decline in dollar demand means the U.S. has to offer higher yields on Treasury bonds to attract buyers. Higher yields mean higher government interest expense, which means more borrowing, which means more dollar supply, which decreases demand further, another feedback loop. In a crash, this would show up as a dollar crisis. The currency would collapse 30% in 6 months. Import prices would explode and everyone would panic. But in a repricing, the dollar just grinds lower, down 2% this year, down 3% next year. Not enough to make headlines, but enough to erode your purchasing power permanently. And if you're sitting in a 60-40 portfolio of U.S. stocks and U.S. bonds, both denominated in dollars, you're not diversified. You're concentrated in a single currency that's slowly losing its privileged position. Now here's the part nobody talks about. Fifth, the psychology of repricing events makes them worse than crashes. In a crash, fear is rational. You see your account drop 40%, you panic, you sell. It's a clean psychological event. And because it's clean, recovery is possible. Once fear subsides, people start buying again. But in a repricing, the psychology is different. Your account doesn't crash, it just underperforms, year after year after year. You check your balance and it's up 4%, but inflation was 5%. You're not losing money, you're just not gaining purchasing power. And that creates a much more dangerous psychological pattern. You don't panic and sell, you just keep contributing to your 401k because the number keeps going up. And by the time you realize the number doesn't buy what you thought it would buy, you've lost a decade of compounding you can't get back. Here's a real example. Let's say you're 45 years old with $300,000 saved. Your financial plan says you need $1.5 million to retire at 65. That requires an 8.4% annual return. Historically, the S&P 500 has returned 10%, so your advisor says you're on track. But here's what the model doesn't account for. If we're in a repricing event where inflation runs at 4% instead of 2%, your real return drops from 8% to 6%. That doesn't sound like much, but over 20 years, the difference is this. At 8.4% returns, you hit $1.5 million. At 6% returns, you hit $960,000. You didn't lose money. You didn't experience a crash. Your account kept going up every year. But when you retire, you're $540,000 short, and there's no recovery because the system already repriced. This is the cruelest part of repricing events. They punish discipline. You did everything right. You saved consistently, you didn't panic sell, you stayed invested, and you still lost because the game changed while you were playing it.
So let me show you what this looks like 10 years from now under two different scenarios. Scenario 1. I'm wrong. What's coming is just another crash. Markets drop 35% over the next 18 months. Your $500,000 portfolio falls to $325,000. It's brutal. You hate checking your account. But you hold through it, and by 2032, you're back to $500,000. By 2035, you're at $720,000, assuming historical returns. You recovered. The system worked. Your retirement plan is still on track. Scenario 2. I'm right. What's coming is a repricing. Your portfolio never crashes. In fact, it keeps going up. By 2035, your account shows $780,000. That's more than scenario 1. You feel good. But here's what actually happened. Inflation averaged 4.5% instead of 2.5%. The dollar lost 22% of its purchasing power against other currencies. Commercial real estate holdings in your index funds got quietly marked down. And that $780,000 only buys what $420,000 buys today. You made more money on paper, but you have less purchasing power. And because there was no crash, you never adjusted your strategy. You just kept contributing to the same 60-40 portfolio, assuming the old rules still applied. Here's the identity shift that matters. People who prepare for crashes hold cash, wait for the dip, and buy when everyone else is panicking. That works in scenario 1. But in scenario 2, holding cash is the worst possible move because cash is the asset being repriced. People who prepare for repricing events diversify across currencies, hold real assets, and build income streams that aren't denominated in dollars. They own businesses, real estate, commodities, and yes, some gold or Bitcoin, not because they think the world is ending, but because they understand that the measuring stick is changing. 10 years from now, the people who treated this like a crash will be confused about why their retirement doesn't look like they planned. The people who understood it was a repricing will have adjusted their strategy 5 years ago and will be fine. The difference isn't intelligence. It's not even about how much money you make. It's about understanding which game you're playing and when the rules change. Look, maybe I'm wrong about all of this. Maybe the US figures out how to cut spending, the Fed engineers a perfect soft landing, and we get another 20 years of dollar dominance and 7% stock returns. I'd be happy to be wrong. But the data says otherwise. And the thing about repricing events is they don't announce themselves. There's no headline that says the repricing begins today. It just happens slowly, then all at once. And by the time it's obvious to everyone, you've already lost the opportunity to adjust. You get to decide how you respond to this. You can keep contributing to the same 401k, assume historical returns, and hope the old models still work. Or you can acknowledge that the world your financial plan was built for might not be the world you retire into. This isn't about panic, it's about pattern recognition. Every empire that's ever run unsustainable debt levels has faced the same choice: restructure or inflate. And every single one chose inflation because it's politically easier. The US won't be different. The question isn't whether a repricing is coming. The question is whether you're positioned for it or whether you're still positioned for a crash that might never arrive. Because here's the brutal truth. You can recover from a crash. You can't recover from a decade of slow repricing that you didn't see coming. The game is changing.
Most people are still playing by the old rules. You don't have to be one of them. Thanks for watching. See you in the next one.